Cash flow will get you through tough times. Equity does not. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I hope you're doing well. Thanks for listening. I want to talk today about what's been on my mind, and it's cash flow versus equity. It's risk versus stability. It's long-term versus short-term. And so this has been going on in my mind. By the way, I struggle through this all the time. So when I started in real estate, my goal was to own a bunch of apartment buildings. I wanted to, my original goal, I wanted to own 1,000 units. I thought if I had 1,000 units, things would be great. I've far surpassed that and things are great, but I still struggle with, do I own things long-term? And by long-term, I mean, just we don't necessarily have an exit vision in mind. We say, we're going to own this property. We're going to cash flow. We're going to do certain things to it to improve the property, right? Renovate, lower expenses, do, whatever, add a clubhouse, whatever it might be. We're going to make the property ours. We're going to make it great, and we're going to run it, and we're going to cash flow it, and we're going to keep it for, potentially very long term, depending on what happens with the market and all kinds of stuff. And then there's the other side of me that says, well, maybe we should just do those renovations, maximize the value, and then exit the property and do it again. And that's, a lot of people call it value add. Investing, it's flipping apartment buildings. And so most of that have listened, I used to flip houses. And I also used to own a bunch of single family duplexes, fourplexes that were long-term. And so what I had is kind of the combination, right? I flipped a bunch of houses and I also owned properties long-term. Now that was great, but what I found is that flipping was exhausting. And quite frankly, it didn't make as much money all the time as what you would expect. We would have some really good times where we're making just a pile of money on every flip. And then you'd have other times where you struggled making money on flips. And it was like seasons would happen. And I didn't do it for a terribly long time. I didn't go through any, big market cycles. I started in 2008 flipping, and I was really done flipping in about 2016, 15, 16. Did a flip in, I think, 2021. But for the most part, I was, just did it that short period of time. I gravitated towards the long term because what I saw is that with my rental properties, I was actually building greater amount of equity, and I was also cash flowing. And so when you really looked at it, the returns were better. Plus, I didn't have tax consequences that I had with these flips. And so here's what I'm seeing. You've got a lot of these new syndicators, and myself included, by the way. So I'm not saying I'm not doing this. And by the way, I'm not going to bash either side. Well, maybe I will. But I don't think there's a right or wrong answer necessarily. But what a lot of people were doing is flipping properties, and they were doing really well doing it. Now, there's a lot of companies that popped up that had never done a deal, or, just had very little experience. And all of a sudden we're buying these apartment buildings, and in 12 to 24 months, they had done some value add, had raised some rents, had proven, quote unquote, proven concept, and then they would sell it. And they, had this great reputation. Then all of a sudden, wow, look at the experience they have. This company or these companies, man, they've made so much money. They've done really well. And again, we are part of that. We bought and sold properties and did extremely well on them. We bought and kept properties and did extremely well on them. And so we are, I'm not saying we're not a part of that. We also grew quickly, um, and we also flipped properties as well. And so that's okay to an extent, but here's the problem. And here's what I struggle with. And I, as I get longer in my career, I've really decided that flipping properties, flipping apartment buildings, and single family homes for that matter, is not a great business plan. It's just not. And it works when it works, but then it doesn't work. And in times like what we're seeing right now in multifamily, we're going through a little bit of a reckoning here. And so you had all these companies that bought properties on short term bridge loans with rate caps in place and all that kind of stuff. And so rates were super low. And the rental market was going up like crazy. And in some places, it went up 20, 30%. Rents went up 20, 30%. And now what we're seeing is rents are flat. They're going down in the Midwest. They're still strong. They're still, 3 to 5%, but not compared to what they used to be. And in many of these markets, they're negative. And the interest rates were, 3%. And now you're sitting here triple that, double to triple that, depending on what kind of loan you have. Some of these bridge loans are 10% or greater. And yeah, people buy rate caps, but also rate cap is buying buying your payments basically. So it's not like you're saving money by doing a rate cap, right? You just pre-spend the money. And so they're putting rate caps on these bridge loans. And if you don't know what a bridge loan is, like a hard money loan for single family houses, it's like a hard money loan, super high risk, short term, talking 2 to 3 years with some potential extensions, but the lender doesn't have to extend. They can decide if they want to or not. And then high interest rates, right? And a lot of fees, very fee heavy. And so you got all these deals that are leveraged to the max, 75 to 85% loan to cost. And they don't cash flow. And they never intended to cash flow. They didn't care if they cash flowed. And so what's wrong with that is that when the market shifts like it did recently, you can't refinance because you're in this property that doesn't cash flow and never will and never intended to cash flow. The only thing you were doing is going to flip it. And so you got a ton of companies that are stuck with these properties that will never cash flow. And doesn't matter what kind of debt's put in place. Even when the rates come down, they're still not going to cash flow or cash flow well. And so I think you're going to continue to see more and more properties. We're not seeing a deluge of properties, but we're seeing more and more start to hit the markets that are foreclosed on or distressed. And you're going to see that. And now, one of the things that's happened is we've been able to kick the can down the road. Lenders have been working with owners and kind of kicking the can down the road. I think the music continues to slow down and likely stop. And some of these groups that have been able to, hide behind it are going to get exposed. And we're working really hard on our properties to make sure that we do get the cash flow on our assets. Happily, we have assets we've always planned on cash flow. So we feel strongly that our properties will cash flow and we will be able to actually refinance. But I know especially from speaking to others, that that's not the case for everybody. And so that's the sad facts. But here's the avoidable thing. Look, I talk with a lot of people, and I was at an event where there was a lot of owners that have owned properties for 30, 40, 50 years. And every one of them says the same thing. And they say, buy properties that cash flow, hold them long term, and get fixed rate debt. Those are the ingredients to success from people that have been in the industry forever. And I hear it from people that have been through cycles too. I don't know many groups that have been through multiple real estate cycles, if any, that use bridge debt. They buy properties either cash or long-term debt. The only thing they'll use, if they use anything, is floating rate agency debt. But even then, they're typically not going to do that. They're going to lock in for 5+ years, and they're going to pay the debt yield penalties. They're going to pay the prepayment penalties if they need to. Because here's the deal. Look, if you go into a property and you have a long-term outlook, meaning you don't need to sell in 3 to 5 years, then you don't need to sell in 3 to 5 years. And the only way you do it is when it makes sense. And so, yeah, you might have to pay a big penalty because you locked in longer term debt, but you got such a freaking good offer that it's worth taking it. Right. And so that's why you're going to take the offers, because it's so dang good and lucrative. You say, well, I got to take this offer. Cash flow will get you through tough times. Equity does not. And there's the difference, right? We have tough times like we have right now. There's a ton of building hitting the market. 2022, 2023 was slammed with construction. 2024 has so many new deliveries happening all across the country, and especially in the smile states, the Southeast, Southeast, Southwest. Like, there's a pile of new properties hitting the market. And so you're seeing a big, big influx in the market, and you're seeing rental prices go down. And so NOIs are going down. And so cash flow is going down. And if you had low or no cash flow, now you have even less. And so you had negative cash flow. Now you've got more negative cash flow, and you can't hold on in equity. Again, it doesn't pay the bills. It doesn't do you any good. So my suggestion, and take it for what it is, but my suggestion is don't do deals unless you have a long-term outlook. Don't do deals unless you have good debt that can withstand the market changing. And buying a rate cap does not withstand the market changing. That is a temporary fix. That is a temporary solution to a problem. And if you don't execute, see, the problem with the rate cap is it puts a time crunch on you. In 3 years seems like a great idea. It seems like a long time from a lot changes in 3 years, but guess what? A lot doesn't change, and things go really fast in 3 years. So I would prefer to lock in at a higher interest rate and be stuck with a higher interest rate for a period of time, and have the no risk, or very, very little risk. That to me is a smarter play. It doesn't make sense on a tax basis either. If you're going to be, so many people want to invest in real estate because they get good tax benefits. But then what they go do is they go flip a property. And again, most people don't call it flipping apartment buildings or flipping retail or whatever, but that's what it is. And so whether you're passive or active, and I talk to a lot of passive investors, and I talk to a lot of sponsors that are raising on capital as well. And most of these passive investors want a couple things. They want tax benefits. Okay. They want cash flow, and they want the security that real estate offers. Well, when you're flipping apartments, you don't get the tax benefits. You get them short term, you get them right away because you can do cost stagger and all that kind of stuff. But then you sell the property and you have a big tax burden. Okay. And so you got a problem on your hands now, and you got to solve for that problem. So it starts out great the first couple of years, but then you got a big tax burden on your hand. You don't get cash flow. You maybe get a little bit. And some of these sponsors fool you by paying quote unquote cash flow through raising extra money. That's not cash flow. That's them using your money just to give you your money back. That's all it is. It's just smoke and mirrors. You don't get cash flow, and you have higher risk. Well, those are the three things you wanted: low risk, cash flow, tax benefits. Okay? Those are the three things I feel like most people want. And when you flip a property, you actually have none of those things. Okay. And so why then go for the flip? And I see a lot of investors that tell me one thing and then they get Google eyed over the IRR. Okay. I saw it today. Somebody posted an ad. It's a sponsored ad on, LinkedIn or Facebook or whatever. 18.9%, whatever it was, 20.2, I can't remember. Big number. IRR return. 3-year hold. Well, again, like, no, that's not a good investment. You got high risk. You potentially have an okay return, but then in 3 years, you're going to have to go find a new piece of real estate to invest in, and you're going to pay a bunch of taxes and depreciation recapture on that gain. And so why not go for a little less IRR and have longer term, cash flow and way less risk on the table? Because what happens to that deal if in 3 years the market hasn't turned? And this sponsor is betting that the market's going to turn and go upside. Well, what happens if in 3 years the market's in the same spot it is today, or maybe even worse? Okay. Well, it can't be, things have gone down. We're already bottoms. I've heard, somebody told me that. Okay. Somebody also told you in 2022 that the sky's the limit and we're nowhere near the top and we're just going to keep on going. Somebody also told you in 2006 that, man, they're not making any more real estate, so you better buy it. Right. You get my point. Just because some expert or pundit told you that we're at the bottom, we're at the top, we're somewhere in between, doesn't mean they're right. And so that sponsor is betting, they're betting on timing the market. And if they're not timing the market and they don't have good cash flow, which my guess is they don't, they could get stuck. And they're likely doing bridge debt. They're likely only locking that debt in for 3 years because that's just bridge. And they likely only have a 2 to 3 year rate cap, because that's just how it goes. And even if they have some money set aside for a second rate cap, who's to say what the cost is going to be? And who's to say the lender is going to extend? And so there's just a ton of risk. So I guess, lots of thoughts that I can continue to go. But look, if you're a long-term, if you're a passive investor, you're active investor, you got to really think about what you set out to do. What's your real game plan? Why did you get in this business in the first place? And if you got in this business to strike it rich, get rich quick, go into a different business. Tech is probably your better industry. If you got in this business because it provides great tax benefits, you've got nice cash flow gains, and you've got excellent risk-adjusted returns, then think about that and go with the proven strategy that's been proven for hundreds of years, and go with long-term cash flow properties, and don't go with the risky apartment flip or retail flip or office flip. Now, is there a time and a place to flip a property? Absolutely. And so, look, we're looking at buildings that have high need for capital, that are fairly vacant and distressed. Are those good flip candidates? Do we build a ton of equity? Do we have very little cash flow? Yes. But we still look at those properties on long-term lens. And here's the beauty with the long-term lens. And when we look at a property with the long-term lens, we can say, okay, this property's got all these warts up front. We can build a pile of equity by doing X, Y, and Z to it. And we got no cash flow to start with. But that's okay, because once we're done, now we can start paying our investors 8, 9, 10% cash on cash return. Now we can hold this property for 3 more years, 5 more years, 10 more years, 15 more years, and not have to worry about exiting. And when we create a ton of equity, we've got all this cash flow that we also create with a long-term outlook. We have flexibility. When somebody comes to us and says, hey, well, you bought that building for $10 million and we're willing to pay you 25, we can say, okay, does that make sense? Yeah, let's take our chips off the table on this deal and go into the next one. But if we don't get that offer, or if we just say, look, that just doesn't make sense, let's refinance this property and continue to hold, we don't have to sell it. We're not forced sellers in a bad market or in a situation we don't like. Last year, we put, maybe it was even this year, we put a supplemental on the property. We've held that property for 5 years. We put a supplemental on it. And now, look, we're probably going to keep it for long term. Now, could we sell it? Sure, we certainly could. But we're looking at that property on a long-term lens. We got our investors all of their capital back, 100% of their capital back. So they're making an infinite return on their investment now. They're still getting cash flow distributions. We actually gave them all their capital back, did some capital improvements, and now we're starting to distribute capital right back to them. And eventually we'll sell it. But does that need to happen this year? No. Does it need to happen next year? No. And we've already held it for 5 years. So we are anti like the new syndication model where you have to flip a property. Think about what you want to do with your investments, decide what the best strategy is for you, and move forward with that. And don't get caught up in the shiny objects. Don't get caught up because of that big IRR number. IRR is a big distraction. It means very little to you. You have to look at the whole picture. You have to look at your goals, and you have to understand that, yeah, IRR is just one little aspect of it. It's nice to see, but it doesn't tell the whole story. So look at each investment, look at your strategy. Don't get caught up with the shiny object syndrome. It's easy to do. I've done it plenty of times. I still struggle with it. But man, long term, in my opinion, is the way to go with the strategy and the ability then to sell in the short term if it makes sense, to be flexible, to be nimble. All right, that's all I got for today. Thanks for listening, and you have a fantastic rest of the day. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.